Financial feasibility. Feasibility study. Do the numbers stack up? Will the end product sell at a price you think after it is complete? Will paying X amount of dollars for the land justify the end value of the townhouse at Y price? What should I pay for the site? These are some of the questions that we got to answer when we're doing a financial feasibility study on any site. Determine the financial viability and profitability of a project. The thumb rule is feasibility must stack up at the current market level, not in the future, not what you think that the market is going up. So yeah, it's okay to pay more for the land at this stage. 2-second FISO. Later on, we will discuss a 2-second FISO template that you can go through. Who should do it? Someone with complete knowledge of the entire development process, or a development manager could do it, or a quantity surveyor could do it. Even architects do it. So financial feasibility can be done by any of these people. Financial feasibility is an evolutionary process. So basically, everything is an estimate. Everything is an estimate that we think that it's going to cost, and in some cases we actually go out and find out exactly what it's going to cost, so that the estimate is actually an actual figure. So but what you do have to remember is, because it's an estimate, a feasibility will never remain exactly the same when you start off with. Over a period of time, when the development is unfolding, it changes. There'll be costs that you would not have think of, or there'll be allowances that you would have made for certain things, and they would have come out to be a little bit more, a little bit less than what you had estimated before. But what you got to remember is that it just has to be right, not more, not less, especially when you're determining the end value of the townhouse or the apartment that you are actually developing, because otherwise it will end up killing the deal. Let's look at this table. The reason I've put this table together is because I wanted to show you and explain you a concept. GRV stands for gross realization value. And say, for example, you're developing townhouses in an area, and the end value of those townhouses is $500,000. So you pay $120,000 for land, and if you calculate the construction for that townhouse, you're going to end up spending $260,000 for construction. On an average, you'll spend about $5,000 per townhouse for consultants. Now, this could be a development with 8 townhouses, 6 townhouses, or 4 townhouses. I'm just taking townhouses as an example for this, to explain you this concept. What's important is to grasp this concept rather than actually looking at the numbers. If you're paying a council contribution in Victoria, it's about 4% of the land value. So I've got a formula here that calculates 4% of the land value. And GST, 10,000. Now that's an average. That's an average because when you build, you claim GST on the construction, and all the permits, all the fees, and all the professional fees, you claim all the GST. But when you actually sell it, you pay the GST, and the difference is what is left that you will have to actually end up paying back to the taxation office. So it's an average, for example. Marketing costs about 2.5% of the sale value. So sale value is 500,000, and that gives us 12,500 for marketing costs. Miscellaneous and finance. So if you were to finance this, that's also an average. If you were to finance the development, depending upon what equity you put in, it's just for me, it is only an average figure that I use to quickly determine whether or not I need to dig deeper for this. So this is not an all-in-all this is not the best feasibility, but for me, I use it all the time for every deal before I spend a lot of time on it. So that's why I call it 2-second FISO. And when you run your numbers this way, you can instantly determine whether or not you need to spend more time on this deal. So now you got to understand is this: the sale value here, GRV, is going to remain constant because it's for, let's say, 3-bedroom, 2-bathroom townhouse. So the market only allows a 3-bedroom 2-bathroom townhouse, market only allows 500,000 for it to be sold, because as you know, price is determined by demand and supply. And if the market says, we can only afford to pay 500,000, and you look at the comparable sales and townhouses for 3-bedroom and 2 bathrooms are coming in at 500,000, you cannot actually expect to get more than 500,000. So this GRV, the gross realization value, remains constant all throughout. Everything else underneath except for land is constant. If it's a 3-bedroom 2-bathroom site, it does not matter where you're building it, it'll still gonna cost you 260,000, and all these averages are gonna also remain constant. However, if you move on to the next column and you see that if somebody asks you more for that land and you paid more, let's say you paid $10,000, it will shave off 2.72% of your profit, of your development margin at the bottom. So anytime you go over $10,000 in land value, you'll see how your development margin will start vanishing, will start evaporating. And if you've paid, I don't know, maybe about $70,000 more than the market, you've actually gone into negative here. And this is a cumulative figure, which basically is that if you paid more than 20,000, so every 20,000 you were shaving off 5.31% of your development margin. Because just because you paid more of land here, that doesn't mean that you'll get more you get the right to actually sell the townhouse for more. So just make sure that what you are paying for land is always in line with what you can make at the top when you've actually built your development. So this is the number one concept for this, and trust me, I paid about $35,000 to understand this concept. But it's very important, and everyone should understand this. I'll show you another table. That's basically over here. What we are doing is, in order to make sure that we still make the same constant development margin, we need to sell, and assuming that the land value is gone up 10,000 every time, we need to sell them at least at 2.42% more to accommodate for the 10% increase in the land value. So if, for example, the asking price is, let's say, 160,000, and you got to make sure that you can sell it for 550,000 at the end of it in order to be able to make the same amount of development margin. Now, if you can't sell it for 550, that means that the vendor is asking too much for the value of the land, and that basically means you move on, you do nothing, you do not negotiate, and you move on. In this section, all I'm doing is I'm discussing the various constituents that actually make a financial feasibility study and all the things that come together. And I'm just giving you, these constituents are not going to be used for every development, but they will be used for most of the developments. And there will be some, I use them as a checklist. So if I was to do a full-scale feasibility study, which I'll show you when we get to the complete property development system, I use them as a checklist to make sure that I'm not missing out anything. And the template that I use comes pre-populated with this. So land acquisition costs are costs like purchase price, legal, stamp duty, buyer's agent's commission. Finance costs are brokerage fees, establishment fee, valuation, interest, annual fee, admin fee. There are all sorts of fees there. If you look at drawings and professionals, you're looking at 3D artist impressions, architectural drawings, civil, electrical, hydraulic, joinery, landscape, mechanical, re-establishment surveys, structural drawings, working drawings, engineering drawings. If you look at reports, there's arborist report, asbestos, building surveyor, CHMP. I'm not sure if this is applicable in Queensland, but in Victoria it's called Cultural Heritage Management Plan. So anytime you're actually buying or developing a property close to a water body, then you have to get a Cultural Heritage Management Plan, and I'll explain that to you in the complete property development system. Dilapidation report, energy report, environmental audit, feature survey, fire engineer report, soil report, specification, town planning and conditions, traffic management report. I think out of all of these, dilapidation report is one report that you might not need to undertake, because it's actually taken care of by your builder. And because we build our own thing, our own development, I actually put that in with my feasibility, so that I've accounted for it. Construction costs are building costs, external costs, civil costs, which happens when you are doing land subdivisions. Contribution and charges, council fees, service connection fees, electricity, gas, water, telephone, parkland contributions, council contributions, number of dwellings divided by land as a percentage, sewer and water contribution. You need to get the Plumbing Industry Commission number in Victoria, which is called the PIC number. Land holding costs are land tax rates. Selling costs are, when you go into selling, it's not just the agent's commission. You got to understand you'll be spending something on advertising, some commission, 3D artist impressions, catalog, website, contract of sale, legals, owners corporation, and so on. And some miscellaneous costs are building insurance, title, registration, and so on. This is an actual feasibility for a project, for a 4 townhouse project, and I just wanted to show you that you've got land costs here, purchase price, transaction costs, development costs that you can put together. You've got professional fees, contribution and charges. Now the professional fees over here look inflated because for me this is a development management agreement that I've done with somebody else to develop their block of land. So basically I get to develop it for a fee without actually using my own money, but the profit actually goes to the client. But because I do this, I picked up this client and I'm now putting together 4 towns. I've actually taken the council, held their hand, taken the client through to council, through town planning to get the permit for 4 townhouses, and then we're going to build it for them. So that's part of their feasibility. And if you look at this, there's 14% development margin, which for them accounts to about $350,000 in profit. Here's the 2-second template that you can use to determine a value of whether or not you need to dig deeper for any development, for any site that you're looking at. What you can do is run through this template and determine very quickly, without spending too much time, whether or not you're actually going to go ahead with this deal or not, or whether or not this deal is even worth looking at or looking deeper. So what I do is here, for example, I'm going to put townhouse on it. And what I look at is that, okay, the size of the townhouse is going to be 20 squares, for example. And all these yellow boxes are the boxes where you actually need to put in some value. So it's 20, for example, in Victoria, we've got 20 squares, everybody talks in squares. So we put 20 squares, which equates to about 185.81 square meters. And if I have to pay 700,000 for land value, and I'm going to put, for example, 6 townhouses or units on them, and in Victoria the stamp duty is about 5.5%, but I allow extra 0.5% just for legal settlement. Because I'm doing it really quick, I do not break that down, and I just allow 0.5% for transaction costs. So I put 6%, that gives me 42,000, which basically tells me that for each for the land value for each townhouse, I'll be paying 123,000. So if I look at the cost plus meter square, this is for cost of construction, and because we build, and because from the past projects that we've built, we've actually ended up building them at $1,400 per square meters. I'm pretty sure you can find a lot of builders who can build at that price, in Victoria at least. I'm not sure what the price is in other states, but in Victoria, 1,400 to about 1,600 is just about right if you're targeting a medium to if you're targeting a medium and a little slightly higher finish, and this is a turnkey price. So that's what we do. GRV, you got to find out if these townhouses you can sell them for 520,000 or 600,000, For example, just make sure that you're not kidding yourself with this price. So that price is important, and you need to have it just right. So for example, let's say 550,000. I'll be able to sell that townhouse. So it picks up the land value from there. It picks up the construction value, and consultant, counsel, GST, marketing, miscellaneous, and finance are again averages. Now you can use my averages, or you can use your averages, but this is not to determine the exact feasibility. This is only for me to figure out whether or not this deal has enough meat in it or enough profit in it, so whether or not I should do a full-scale feasibility. So I would always go through this and figure out, okay, it shows a development margin of 19.88%, which is pretty good. I'll still do it. So even at 500,000, can I do it? No, 500,000 actually drops it down to 8.98%. Is that worth it? Which basically gives me a $40,000 profit. That means I'm paying too much for land value here. But if I could only put 4 townhouses on it, look at this. If you could only put 4 townhouses on it and everything is constant, you're actually going to run a loss here, unless you can sell them for 650,000, for example. That in that scenario you can make 24,000. So what I do is I spend maybe 2 minutes, maybe 5 minutes just playing around with these figures to figure out, okay, now this looks good, what else can we do it in? And then I go from there and look at and try and tick all my boxes to make sure whether or not I should be going for this deal or not.